And welcome back again to Tim Bingham's Options and Volatility newsletter. Taking a look today, our most recent vol capture trade, or trades I should say, on ERO Copper, ERO, where huge, unusual call buying sets up ideally for a vol capture trade, leaning bullishly with those massive call buyers and more neutral trades as well. So let's jump in and take a look. First of all, here is the scanners that kind of highlighted it. Here's the one I built on my Thinkorswim desktop that kind of highlights unusual option activity with that implied volatility increase of at least 3 vol points. So not only unusual option activity, but unusual option activity that drives the prices up, right? That's what we look to capture out there. So there is ER, the November 30 calls, as you see, over 15,000 contracts traded. Here's another scanner I use that does a similar thing. You can see overall 41,000 contracts traded versus less than 2,000 average volume, 30 times normal volume to say the least. We'll take a look in a second how it was mostly on the call side. IV percentile now at 100%. In other words, option prices the highest they have been over the past year. Taking a look at that IV chart, easy to see that, right? Here is that huge jump, and I used the 60-day IV, but certainly any of the time frames, as we'll take a look in a second, would react the same way. Just massive lift in implied volatility. Here it is across the term structure of vol, across every expiration. IV lifted from yesterday, where it was trading basically under 55 and more towards 50 on the longer end, to over 70 and well above 65 on the longer end. You can see the Nova options, right, had the majority of the volume, over 27,000 contracts traded there. That's where a couple of our trades we're going to take a look at we put the trade on there. Jan certainly got a nice vol lift, Dees as well. And you can see that over 40,000 calls traded, over, swamping 744 puts to say the least, right? So just a huge amount of call buying out there that lifted implied volatility. Here you can see the generalized implied volatility of a 25 delta call and put. You can see they were chopping right around that kind of, upper 40 level, started creeping a little bit higher, right? When we saw some market weakness, the VIX kind of picking up. And then yesterday, woof, that huge pop here, especially as we can see on the call side, calls jumped up appreciably, now trading at a 10-point IV premium to puts. Normally, you see the reverse of that, right? So all this huge call buying that we saw, those 40,000 calls versus less than 1,000 puts, right, drove up the implied volatility of the calls especially, which leads to one of the trades, the covered call or the buy right trade, buying the stock, selling that overly expensive call, both on a actual basis, right, as IV just shot up huge, right, and a comparative basis as well. Here's a look at IV generally on a 60-day basis over the past month or so. You can see it been just kind of slowly creeping higher, hanging around that lower 50 level. Then when we saw that huge volume come in, that huge spike in IV. So this is what we look to capture by selling this pop in IV and then covering it when it does drop. And you can see the calls, which are in the gold, versus the puts, right, now trading at a massive premium. Obviously, because of put call parity, everything kind of has to move together. So we're seeing the out of the money calls, where the majority of the volume is, absolutely trade at a very rich multiple, pulled off a longer time frame of those same sort of delta options, the 60-day 40 delta call and puts, right? And you can see over the past 6 months, right, we've seen a few chops around earnings and so forth. We do have earnings coming basically first week in November, so plenty of time for that reversion. We probably won't be allowed on that trade for that long. But you can see where that volume comes in, that huge run up here. So by far the highest IV over the past 6 months, sets up ideally for a couple trades to capture this big spike. The easiest one being a buy right trade, right, which is simply going out, buying the stock, selling the calls. I chose the November slightly out of the money, 25 calls. So went back to October 9th. The last time the stock was kind of here, trading up around these levels. Stock closed at 23.42 on the day. Those calls closed right around 122, as you can see. The buy right, which is simply buying the shares, selling these calls to protect it, closed just over $22, right? The IV on the trade, the IV on the calls we're selling, just over 56. The call delta was 42, right? So the buy right delta is 100, right? Because stock has 100 delta, less the 42 delta gives you a 58 buy right delta. So basically reducing your risk by almost half, but leaving yourself plenty of upside, right? With the stock at 23.42, you really don't, if you will, worry about getting assigned on it until the stock certainly gets to 25. The return of exercise, which is basically how much you make if the stock does close above and you hold it until expiration and it closes above 25, you'd make a little bit over 12.5%. Standstill return by selling that call, right? You're bringing in about 5%, a little bit more, that protects your downside. And that's what you'd make if the stock basically was here, at expiration as well, and that call expired worthless. Fast forward to yesterday, we saw the stock at 22.71, right? That no 25 call trading just over 85 cents. So the buy right, which is buying the stock, selling the call, 21.83, right? And you can see that did drop a little because the stock went down. You'd expect that, right? If the stock drops, you'd expect the buy right? Because it's a bullish trade still to drop in value. If the stock rallies, you'd certainly expect the buy right, buying the stock, selling the call, to go up in price, right? IV still hanging around mid 50 level, has crept up a little bit. Call delta now at 34, right? Stock dropped, so the delta on the call got lower. The buy right delta at 66. Your return of exercise now, right? Because you're a little further out of the money on the 25 call. You had a bigger upside return of exercise, but your standstill return now under 4% because simply the fact that call premium doesn't provide as much downside protection. Fast forward to today, the stock closed at 23.56, so virtually the same as it was back here, right? But you can see that November 25 call, right, closed at $1.80, right? Back where it was before at about the same price was $1.22. So it has gone up 60 cents roughly from when it was back at the same price. That buy right now has dropped down to 21.76. Remember yesterday, the stock was at 21.83, the buy right, which is buying the stock at 22.71, selling that November 25 call. The buy right, which is a bullish trade, actually got cheaper. Why? Because we saw the stock, right, went from 23.56 today from where it was yesterday. So we saw that stock, as we said, right, 85 cents, but we saw the call option, and these are out of the money calls, right? These are nowhere near the high delta calls, right? We saw the calls actually go up more in price than the stock, which is highly unusual to say the least. Hence that covered call trade actually cheaper, right? Why? Because the IV now at 77 and change, before it was at 56. So we saw that IV just explode on this covered call trade, right, by over 20 vol points. So the call delta now at 46. So the buy right, you're basically, by doing the trade now, cutting your, if you will, risk in half. Your return of exercise now almost 15%. Back when it was at a similar price, your return of exercise only 12.5%. Your standstill return just over 5% back then, and now you're looking at something 7.5%. So you've increased your overall return very nicely, right, with the stock getting closer to that $25 strike price, right? And you also had a little bit of time decay from the last time it was here some 4 or 5 trading days ago. So certainly doing a covered call where you can buy the stock cheaper, sell the call more expensive than it was yesterday, follow that big call buying out there, certainly makes a lot of sense to me. And notice too that the implied volatilities, right, on these options, right, the out of the money calls, as we said, now trading at a huge premium, as we looked at here, right, to the out of the money puts, making a buy right, selling these certainly comparatively and actually expensive options that have shot up in price across the board, especially the calls, makes ideally for a buy right trade. And that's the simplest trade. Any account that trades options is approved for that. A couple other trades. Here's a strangle trade, kind of went through the same formalities, went back to the last time the stock was right around here at 23.42 on October 9th. The strangle selling the November 20 put and the November 30 call, trading just under 80 cents. The IV on that strangle, the kind of average of the two, just under 58. The delta on the trade, if you sold the put and the call, it'd be about 4 deltas net long, because the put, the $20 put, a little closer to the money than the $30 call, which is further out. So your upside cushion, in other words, how far to that $30 strike price, over $6.50. The downside cushion, roughly $3.50. Yesterday we saw the stock at 22.71. That strangle crept up in price a little bit, right? Simply because it got a little closer to that downside $20 put strike, and that's natural. Crept up by a nickel. IV stayed basically, the same, right? For the all intents and purposes, right? Your upside cushion now a little bit more. Your downside cushion a little bit less. Your delta increased to 9 deltas, so you'd be a little bit longer, which makes sense. The put is closer to perhaps getting in the money. Fast forward to today. The stock at 23.56. That strangle, the Nov 20 put, Nov 30 call, exploded to over $1.50, right? Why? Because we saw the IV jump to almost 80, where before it was well under 60. So huge explosion in IV. And believe it or not, even though the upside call is still over 6 points out of the money, the put less than 4 points out of the money, it's a now net delta short trade. Why? That huge jump in IV makes the upward drift, right? Force the call deltas on these somewhat lower priced stocks, and $25 stocks is somewhat low price in this day and age. So it forces the delta up on the calls because the puts are bounded by 0. So you get kind of an artificial net delta short. But the main thing is you're able to sell this strangle for $1.50, when back here it was trading at basically half the price. So you can get twice as much for that strangle, right? With the stock really not moving, and in fact moving a little bit better for you, right? Because your upside cushion is still plenty good, 644, 658, but your downside cushion has increased as well. So a trade that has worked its way towards a better overall price has doubled in prices. Amazing here, simply because of that big call buying leading to the IV. And then we can also take a look at the straddle going out to January this time. Same sort of scenario here, going back to October 10th. The stock at 23.42. The straddle, the Jan 25 straddle, which the puts are in the money, the calls are out of the money, right? So it's basically a slightly bullish 7 deltas net long. IV at the time trading just under 49. That straddle priced at a little bit over $5. Yesterday the stock 22.71. That straddle, as expected, crept up a little bit. Why? Because the puts are a little bit more in the money. The call is a little further out of the money, right? Is net delta long trade. You'd be 17 deltas net long, right? IV crept up slightly to now over 50. Before it was just under 50, but not a huge jump. Then fast forward to today's close, the stock 23.56. And remember, this was a bullish trade. So if you were bullish, you have the stock go up in price, you'd expect your trade to make money. But if you would have sold that straddle yesterday at 520, you'd be down about $1 on it here. Why? This huge jump in implied volatility, even out in Jan, right, of over 13 vol points. So this sets up ideally for a sell straddle trade. And lo and behold, even though the put is still in the money by about $1.50, the 25 put call out of the money by about the same amount, $1.50, the delta now on the trade is -1. As you can see, the delta 51 on the $25 call with the stock at 23.56. We go back to when the stock was at 23.42. The delta on that call, right, was only 47. So you can see how the jump in implied volatility just forces those deltas up simply as a matter of the jump in implied volatility. So certainly selling the straddle here to capture the vol would be a very good way to handle it. Go out to January, you get a little bit bigger premium on it. That NOV 2030 strangle, certainly able to get, in essence, double the price from the last time it was here, and having go up in price from yesterday when it should have gone down because of that huge jump in implied volatility. Or if you want to lean bullishly with those big call buyers out there, right? And we do see all that call volume, as we said, then doing the buy right makes a lot of sense as well. As far as the margin on the straddles or strangles, basically not too expensive. This is for that November 2030 strangle. Your margin requirement would be roughly about $400 per strangle that you sold. You just take the worst case scenario of the call or put, and on the straddle out in January, you'd be looking at about an $850 requirement for doing it one time. So hopefully provide some insight into how we go about identifying these trade opportunities, structure the trade, and take advantage of them. We'll be waiting for this to revert back, and we'll update you on that when it does. And the key to all this, as we said, is that trading is all about probability, not certainty. So make sure you take advantage of the edges, put on your hedges, and position size accordingly. So until next time, as always, here's a good trade.